very interesting. Okay, let me go across. We have Sudhanshu Jain, CFO at IDFC FIRST Bank, joining us live this morning. Sudhanshu, let me first try and get a sense of where margins are headed. Obviously, we've likely seen the bottom. Am I right in believing that? And what would a 25 basis points rate cut do to your margins if that were to come through? Will it again see margins sink, or will your margins hold, is what I'm trying to get to.
Yeah, thank you for the question. First of all, good morning, all the viewers. On the margins, we did call out that last quarter was the bottom. In fact, this quarter we saw an increase in margin by 17 basis points. And next quarter also we have guided that margins could be 10 basis better from here. Right? That also will come largely because of the reduction in cost of fund. In fact, we expect the cost of funds to come down below 6% in Q4. If another repo cut has to happen, for us about 30% of the book is linked to repo. So that could take off about 6 to 7 basis points when it's fully implemented. But at the same time, we may commensurately bring down the cost of funds further from here. So I think NIMs would be broadly steady or could marginally increase from here on.
Okay. And and this is despite, even if a 25 bips cut could come through, is that the right hypothesis?
Yeah, that's the right hypothesis. So we expect NIMs to be increased in the next quarter for sure. And from there on, even though there may be a cut, NIMs could be still quite stable.
And your cost of funds, you've enjoyed, or rather you've enjoyed a very strong CASA because you've kept your cost of funds elevated. In this cycle, does that structurally reverse? Are you now confident that the customers you've got on board are sticky enough, and are you happy enough with the quantum of customers you've got on board because of the liability franchise tweaking you've done? Or would you continue to be a bank which offers a better rate and continue to attract customers? Are you in the growth phase, or have you matured in terms of the liability franchise?
And definitely we are in the growth phase. Deposits for us are still growing at 24-25%. Loans are growing at 20-21%. So we are definitely in the growth phase. But at the same time, liability stack is also shaping quite well. In fact, to the earlier question, cost of funds, just a data point, when we started at the time of merger, cost of fund was 7.8%, right? We were almost paying like small finance banks. And at that time, mid-sized banks were at 630. So there was a gap of 150 basis points. So during this 7 years since merger, while we have scaled up the deposit book, we have brought down now the cost of funds to 6.1, which is almost mirroring the mid-sized banks. And I sort of guided that we expect this to further come down. So we feel quite confident on the deposit franchise. We feel it's being driven by good customer service, transparency, good corporate governance. We have been expanding as a franchise. Brand is growing. So we feel quite confident in terms of how the deposits can continue to stack up from here.
How do you see the stress in the microfinance segment? Do you see it getting over by the end of Q4, or it will spill over to the next financial year as well?
It's in fact already reflecting our SMA numbers, which is the pre-NPA stage, 0, 1 and 2 pool. That has shrunk by almost 78% from the March peak. Even sequentially, it has come off by 33%. So we feel the pain is largely done and dusted. Some normalization in credit costs could still happen in a quarter or two. In fact, to the corollary, we have started disbursements going up, which means the book can also start growing into the next year, so which would further add to the top line of the bank. So MFI is, I would say, largely done and dusted. In fact, we want to grow the book now.
Right, and no region-specific risks also, right, Sudhanshu, when it comes to MFIs particularly?
In fact, we were largely concentrated in Tamil Nadu. That was because of an acquisition which we had done a few years back. There also, we have reduced the concentration over a period of time. We are diversifying into more states, and hence, we feel now quite comfortable in the MFI front. Collection efficiency in MFI is also now touched about 99.4%. It's almost getting closer to the pre-COVID levels. So we feel this book is very important, contributes to PSL, ROA dynamics are reasonably well. So we want to grow this book into the next year.
It's around 0.5%. You see a significant bump up to the return ROAs from here on as you scale up from here?
Yeah, so we are seeing profitability improving quarter on quarter, and that trend should continue into the next year. This year, profitability did had an impact because of the MFI drag, because of the repo reductions which happened, while cost of funds impact comes with a lag. But into the next year, definitely we see ROA improving quarter on quarter, and it could very well be that we touch again a 1% ROA by end of next year, by the last quarter of next year. So that is something which we are gunning for. So we feel quite confident in terms of how things could span out from here.
Sudhanshu, what I see in the numbers this time, while operating leverage was highlighted in the second quarter, the cost-to-income ratio remains elevated in Q3 as well. Any revision in guidance, any measures to improve?
This has been more, I would say, an income problem. Largely came because of the MFI book reduction, because the repo rate changes which happened. On the cost front, we have been able to contain the OPEX to a great degree. In fact, if you see for 9 months, OPEX has grown at about 12.3, 12.4%, right? Whereas the income has also grown at 11.5%. So we feel that with the pains of MFI now being behind us, the cost of funds reduction still to play out, the income will start growing at a 20% normalized levels, almost like the book growth. And if we are able to contain OPEX around these trajectory of 13 to 14%, definitely operating leverage will start playing out, which is essentially means cost of income should keep coming down from here on.
Sudhanshu, with regard to your immediate ROA, say Q4, you've got reasonable visibility now with regard to slippages and how that is behaving for you and how the book is behaving. Your credit cost number hasn't come down materially. Do you see a material downtick in credit cost in Q4? And would that be, say, 50 bips plus?
We definitely see credit cost sharply coming down in Q4. It's also collection activities are also slightly heightened towards the end of the year. I can't pencil in a number, but definitely this quarter also it came up by about 20 basis points. Next quarter also we see a good amount quantum of decline which could come in here. And even extending into the next year also we see overall credit cost improving. So definitely slippages, you talked about slippages, even slippages this quarter, net slippages have come off by 9%, right? And we also keep doing a lot of policy interventions time and again. So we feel the overall environment is improving and hence the asset quality should also get better over time.
Okay, Sudhanshu, thank you so much for joining us. We'll let you go on that note.
Thank you.
That's the management as well as the outlook with regard to IDFC FIRST Bank. Stock